You've probably seen listings that say assumable mortgage, and with rates still elevated, that phrase can sound very, very appealing. Especially now that the Fed just lowered rates by 0.25% last week, buyers are wondering where real opportunities actually exist. But here's the truth. An assumable mortgage can be a huge advantage or a very expensive misunderstanding if you don't know how it really works. Today, I'll break down exactly what an assumable mortgage is, who qualifies, and what most buyers completely overlook before getting excited about this low rate home. I'm getting more questions about assumable mortgage than at any point in my career, and I totally get why. As of mid-December 2025, the average 30-year fixed rate mortgage is sitting around 6.2%. Meanwhile, many sellers who bought in 2020 or 2021 locked in rates around 2 to 3%. So buyers naturally ask, can I just take over that loan? The short answer is yes, but there are some important conditions and timelines and cash requirements that most buyers don't realize until it's just too late. So what is an assumable mortgage? Well, an assumable mortgage allows a buyer to take over the seller's existing loan, that same interest rate, that same payment, and that same balance that's remaining. That means you could lock in a rate in the 2s, even while new loans are still hovering around 6%. Most FHA, VA, and USDA loans are assumable. Conventional loans almost never are. But here's what many people miss. The seller can't just hand you their loan. You're assuming the rate, not skipping the lender approval. That's why it's critical to ask early in your home search whether a loan is assumable. When it applies, it definitely can become a powerful negotiation tool. The biggest benefit is obvious. It's just lower payments. A seller with a 2.75% rate may have a payment that's hundreds of dollars lower than a buyer financing the same home today, even after the recent Fed rate cut. Over time, that monthly savings adds up and can help buyers qualify for homes they otherwise could not. And another benefit, assumptions often come with lower loan origination fees, which can definitely reduce total closing costs. So how do you qualify in 2026? Well, even though you're assuming a loan, you still need to go through the full underwriting. Most lenders will require steady income, acceptable credit score, debt to income ratio, typically about 43 to 50%, and proof of funds to cover the equity difference. And this last part is critical. If the seller owes $250,000 and the home is worth $350,000, you may need to bring $100,000 in cash just to bridge that gap. Also, these aren't fast. Many lenders rarely process assumptions, so timelines often run 45 to 90 days or more. If speed matters, this may not be the best option for you. So when does an assumable mortgage actually make sense? Well, assumable mortgages can be powerful when everything lines up. They work best if the rate is far below today's market, you have the cash to cover the equity, you plan to stay long term, and the monthly savings justify the upfront cost in time. For sellers, offering an assumable loan can also make a listing stand out in a payment-sensitive market like the one we're in right now. Assumable mortgages, they're not a magic shortcut, but in the right situation, they can be a real game changer. The key is understanding the process before you fall in love with the rate. If you're looking at a home with an assumable mortgage or wondering if your current loan could attract more buyers, reach out for a one-on-one consultation. We'll help you run the numbers, avoid surprises, and decide if assuming a loan is actually worth it to you.